Can central bank policies really destroy your investments? Imagine putting your money into stocks, bonds, or real estate, only to see their value shrink unexpectedly. It might seem like bad luck, but often, it's linked to what central banks do behind the scenes. Central banks control the money supply and set interest rates, and their policies can shake up markets in ways that hurt your investments. When they lower interest rates artificially, it encourages borrowing and spending, which can inflate asset prices beyond their real worth. This creates bubbles that eventually burst, causing sudden losses for investors. From the Austrian economics point of view, central bank actions distort the natural interest rate that would emerge if markets were left alone. This leads to malinvestment, where money flows into projects that seem profitable only because of artificial signals. When these projects fail, it triggers recessions or financial crises, wiping out investments. Libertarians argue that central banks hold a monopoly on money, which creates systemic risks. They often bail out failing banks or intervene in markets, encouraging reckless behavior and misallocating capital. Government guarantees like deposit insurance remove the discipline that would normally prevent banks from taking excessive risks. This can lead to financial instability, which then impacts your investments. When the government steps in to stabilize the system, it often prolongs or worsens economic downturns, making your investments more vulnerable. Some practical ideas from this perspective include limiting or ending central bank powers, removing government guarantees on deposits, and allowing private currencies or free banking to flourish. These reforms aim to restore market discipline, reduce inflation, and prevent artificial asset bubbles. When markets operate freely, investments tend to be safer because prices reflected true supply and demand, not manipulated policies. In short, central bank policies can indeed harm your investments by creating inflation, bubbles, and economic distortions that lead to crashes. Libertarian and Austrian economics experts believe that the best way to protect your money is to have a monetary system free from government interference. This way, market forces can work properly, and your investments are less likely to be wiped out by artificial economic shocks.